What does a war in the Middle East have to do with your mortgage in Canada? A lot more than most people think. Right now, global conflict is affecting oil prices, financial markets, and bond yields, and that is already putting pressure on fixed mortgage rates here in Canada. The Bank of Canada has said the war in the Middle East has increased volatility in energy prices and financial markets, and Governor Tiff Macklem said the war in Iran was pushing oil prices sharply higher in the short term. So if you are buying a home, renewing your mortgage, or even just trying to understand where rates may be headed, this is something you need to know. Hi, I'm Serge Bourgoin with FindMyHouse.ca and eXp Realty, and in this video, I want to break down how the war in the Middle East is already impacting mortgage rates in Canada, why fixed rates are feeling it first, and what that means for buyers, sellers, and homeowners right now. Most Canadians assume mortgage rates only move when the Bank of Canada changes its key interest rate, but that is not the full story. The Bank of Canada held its policy rate at 2.25% on March 18, 2026, yet fixed mortgage rates have still been rising because fixed rates are influenced more by bond yields than by the overnight rate. That means even when the Bank of Canada does nothing, your mortgage options can still change. And that is exactly what we are seeing right now. So how does a war halfway around the world affect borrowing costs in Canada? And here is exactly how that connection works. When conflict breaks out in a major oil-producing region, markets get nervous. Investors start worrying about oil supply, shipping routes, inflation, and global economic risk. The Bank of Canada specifically said the Middle East war has increased volatility in energy prices and financial markets. When oil prices rise, inflation concerns often rise too. And when inflation concerns rise, bond yields can move higher. That matters because Canadian lenders use Government of Canada bond yields, especially the 5-year bond yield, as a major benchmark for pricing 5-year fixed mortgages. So the chain reaction looks like this: war in the Middle East, higher oil market risk, higher inflation concerns, higher bond yields, higher fixed mortgage rates in Canada. That is the real connection. According to mortgage broker Marshall Tully, 3- and 5-year fixed mortgage rates increased by about 0.5% in just 3 weeks, and he warned that the trend could continue. Canadian mortgage reporting has also said elevated bond yields are putting upward pressure on fixed mortgage pricing. That is a meaningful move, because even a 0.5% increase in mortgage rates can affect monthly payments, affordability, and how much home a buyer qualifies for. So if you are out there shopping for a home, this is not just economic news. It can directly affect your budget. Now here is something important. Fixed and variable mortgage rates do not react the same way. Variable rates are tied more directly to the Bank of Canada and lenders' prime rates. Fixed rates are tied more closely to bond yields and market expectations. That is why fixed rates can rise even when the Bank of Canada holds steady. Mortgage industry sources explain this distinction clearly, and rate trackers in early April showed lower variable pricing than fixed pricing nationally. So right now, fixed rates are showing the impact first. So what should buyers and homeowners do with this information? First, pay attention. This is one of those moments where global events are having a direct local financial effect. Second, if you're planning to buy soon, get a mortgage pre-approval and rate hold in place. RateHub says borrowers can often secure current pricing for up to 120 days through a rate hold, depending on the lender. Third, if your mortgage is coming up for renewal, now is a good time to review your options early instead of waiting until the last minute. And finally, make decisions based on your own timeline, payment comfort, and risk tolerance, not just headlines. The big takeaway is this: the war in the Middle East is already affecting mortgage rates in Canada. Not because it changes Canadian real estate directly, but because it affects oil prices, inflation expectations, financial markets, and bond yields, and those factors feed into fixed mortgage pricing. So even though the conflict is happening far from home, the financial impact is showing up here in a very real way. If you are thinking about buying, selling, renewing, or refinancing and want help understanding what these mortgage changes mean for your real estate plans, reach out to me directly. I'm Serge Bourgoin with FindMyHouse.ca and eXp Realty. If you found this video helpful, make sure to like, subscribe, and share it with someone who needs to understand what is really happening with mortgage rates in Canada right now. And I'll see you in the next video.